Welcome, Victor. For a bit of background on Victor, for those of you who don't know, Victor is a founder and he's a managing partner of the M&A advisory firm Magister Advisors. He's advised on over 120 transactions across 30 years of practice, and he's helped found and build 3 successful corporate finance firms in the process. Magister Advisors is focused on M&A exits and larger financing rounds. By larger, we're talking $50 million type deals. And they've worked on transactions including sort of Twigger Foods, their Series B round, Cellulant's 47.5 million Series C round. And so we're going to be talking about some of these deals in a bit more detail and just broadly about deals in a bit more detail. So I think just to start, I'd love for you to just talk to us about your background in general. Doing advisory for 30 years, what kind of deals you worked on, just career path a little bit broadly for the audience to get a bit of context.
Sure, I'll do this very briefly. You covered a lot of this. As far as, for people who are joining this webinar, I've been doing advisory work for 30 years, mostly with European-based tech-enabled businesses. And it's been a mix of fundraising and M&A, and they bleed into each other when we're talking about later rounds. So about 3 years ago, consciously, we extended our practice to East and West Africa. Principally, I was born in Cairo originally, so running around Lagos or Nairobi is not a big deal for me. And I saw the opportunity to get involved early in the ecosystem. And having come to Europe 30 years ago, you couldn't spell technology. So I've grown my career, built my own profile as the ecosystem in Europe has grown. And so seeing the same kind of potential evolution on the African continent was a natural opportunity for me and us to start investing more and more time. It has become a much bigger proportion of the work we do. And in fact, I mentioned this to you, I think when we talked a few days ago, we made a conscious decision towards the end of last year that if a project came in, an African project and a European project, both came in the same week, that we would prioritize the African one, which was a very big change for us. And if you'd suggested that's what we would be doing 3 years ago, I would have laughed at you. But it's a function of a number of different things, which I'm happy to go into. But as a result, we've not only helped Twigger and Cellulant, but we've helped a number of other companies on the continent, and we're currently working on a number of larger fundraisers. When I should be clear that in our African work, we define a larger fundraiser as $30 million plus. Okay. When we take on work in Europe, it's $50 million plus, and that just reflects the earlier stage of the ecosystem. But we decided a few months ago, well before COVID, to double down on our Africa work. I would not be surprised if over the next few years, it ends up being half of everything that we do year in and year out. It's just a question of how quickly the ecosystem develops. But we're huge fans. I voted with my time and my career. So I don't think there's a better statement than that.
That's fantastic. Super interesting. I like your point around sort of deciding to prioritize Africa. And I want to talk a little bit about that. But before we get into that, I want a bit of background on just how you think, sort of the African ecosystem today is different or similar to Europe when you kind of started doing technology across Europe, basically.
There are a lot of similarities. So if I go back 25 years or something in Europe, it was a very embryonic ecosystem. People had to scrabble around for capital, just as a lot of African CEOs are scrabbling around for capital today. One big difference was impact money didn't really exist back then and didn't exist in Europe, whereas it's been a very big feature so far, but I think we all know that. There are a number of differences, and I think more specifically to the audience we're talking about. One, the reason that we double down is because the CEOs that I and we have worked with are better quality person to person than the CEOs that we have and are working with in Europe. And that's not because we're working with worse CEOs in Europe. They are better quality. They're just many fewer. And I thought to myself, why is that? Why should that be? I realized after a while that it's so hard to build a growth company of scale in Africa today that those people who are able to do it, build a company of a few hundred people, get to a certain degree of scale, have to overcome so many challenges. Something is always going wrong every morning somewhere. And there's so much friction that those companies that are able to overcome to a certain extent that friction and be able to build a business have to be better quality. The degree of adaptability that African CEOs, at least in the tech-enabled companies we work with, the degree of adaptability that they have to have is much better developed than you would ever see or need to see in Europe or the US. And it's the privilege of my working life to be able to work and help great CEOs and their boards. So when we see that, again, with a smaller number, that is something that's incredibly attractive. And, I know, well, here's how we can help. And there's another difference is that because it's so difficult to build companies of scale, and I'm generalizing here, but I'll try not to be, too arm waving. The friction associated with being able to build a business to a certain degree of scale means that for a large number of companies, they have to be more vertically integrated than they would ever need to be in Europe or the US. Distribution networks are not built, key infrastructure doesn't work, et cetera, et cetera. Everybody on this call knows what I'm talking about. So, but for those companies that have to be more vertically integrated and end up being more vertically integrated, there's a huge payoff, which is across a lot of sectors: distributed energy, agriculture, fintech, et cetera. The margins available at any degree of scale are much greater generally than they would be in other markets. So take rates across sectors are 2x what they might be in India in a similar size market space, or maybe sometimes even 3x. And that's the payoff for having built something that is as differentiated. People talk about building a moat around a business, and it's a very well-known phrase now and very evocative. But when you think about how companies have to try and build moats in more developed continents and economies, it's a challenge. In Africa, just by getting to a certain degree of scale and having overcome a certain number of challenges, companies by definition build a moat around their business much of the time. And that has intrinsically much higher strategic value just by getting to that point. Even if they get to that point with a broader range of services, a little bit more heterogeneous business, a less well-developed second and third line management team that they would otherwise be able to get, et cetera, et cetera. So value gets built alongside companies building a degree of scale, which, by the way, doesn't now exist in Europe or the US. You can build a $20 million revenue company in the US or Europe. That isn't that strategically valuable.
Facebook can replicate your entire business in order.
Oh, well, yeah. Well, that's another element, which is you can build a $20 million business that relies on people like Facebook and Google, and they extract a lot of the margin, extract a lot of the value. I mean, there was an investor on the West Coast told me a couple of years ago, 3 years ago, he said, I've seen 30 pitches of companies coming in raising Series A and B money who basically are going to take half of the money that I give them and invest it in Facebook marketing. He said, after seeing 30 of those pitches, I decided not to invest in any of the companies. I just bought Facebook stock. And by the way, he did pretty well. So, and by the way, it's not lost on anybody here that Facebook has such a low market share in Africa that, by definition, we can talk about them as a point of difference. But my point is, you get to a certain scale in Africa and you have built significant value by getting to that point. Now, there's a negative. The negative is always, life's never works without negatives. The negative is that a lot of African growth companies have to, quote, waste the first few $1 million of money raised to basically be more vertically integrated than they otherwise would need to be. You can't rent distribution and logistics, et cetera. You have to sort of organize it yourself. And so a lot of the costs that companies take for granted in developed markets has to be invested into in Africa. And therefore it becomes, in a capital constrained set of economies in Africa, having to kind of lose your first few $1 million of funding, reinventing the wheel can be very, very expensive.
Gotcha.
As I said, there's a big payoff.
I love your point. Basically, by virtue of solving the problems of operating in Africa, figuring out your logistics, figuring out your supply chain, by even getting a company viable, you've already built a more valuable company than it might be anywhere else. So taking that into account, let me ask about where are you seeing the most activity? What sectors are you seeing as interesting looking across the continent? I know there's been a heavy focus on fintech. From your perspective, what's most interesting?
Yeah, so if you look at the end market spend in Africa, about 80% of it is for essential use cases:
Okay.
energy, money, food, health, right?
Yeah.
So, which is a higher proportion than it is in developed markets, and that's the current state of the continent overall. So, therefore, what you see in terms of tech-enabled businesses and fundraisings, it maps onto that. The biggest sectors are ones that are dealing with essential use cases. Fintech is probably about 40%, maybe close to 50%, if you define it broadly. And then the rest is going to be in energy and agriculture, and probably in health to a lesser extent. So for better and worse, it maps onto the end market spend in these economies. So, and I think for the next few years, we'll probably continue to see fintech being about 40 or 50% because of so much activity in payments and so much activity in companies who are building businesses on top of payments infrastructure. But there's an awful lot happening on the energy and agriculture side that's maybe just a little less exciting than fintech, but just as important. And of course, these sectors all relate to each other. Distributed energy business is a pay-go business in East Africa, and agriculture business, there's a lot of overlap. And when you see companies and markets, oftentimes they've got a payments capability underneath and a fintech or financing capability underneath. Across all of these, if I had to say there's one common denominator as an unlock, if you will, it's financing.
Okay.
So the number one gap, if I had to generalize, is financing for, most enterprises in Africa are small enterprises by definition. So it's a big gray area between consumer and business.
Okay.
And that is an area that banks simply do not play in. For example, something like 2% of all microfinance goes to agriculture, even though agriculture employs 70% of all the working population in Africa.
Yeah.
So, and you have the unlock problem also in distribution, you have it in financing, et cetera. And we're not talking about people borrowing money in order to bet on Premier League fixtures. We're talking about people borrowing money in order to deal with credit payment terms, et cetera, from their own customers and be able to accelerate their business. If you remember, in the 1600s, bear with me for a minute, the 1600s, what got trade going across oceans wasn't ships, it was trade finance.
Yeah.
That's why the Rothschilds are the Rothschilds. And when you look at the current, corollary of that, it becomes very obvious. Banks can't really focus on that market. Their cost to serve is way too high. They don't have the capability to do it. And so in SME lending and financing, consumer financing for essential uses, and frankly, even mid-market financing, many businesses in traditional sectors cannot get financing, and it unlocks markets. And so that's a whole area that cuts across all of these, and somebody's going to build $1 billion company doing SME financing in Africa. Actually, probably more than one. And it won't be banks.
I think there's a number of people trying now. So that's going to be interesting to see which of them sort of gets to scale. Okay, let's talk about your perspective on the continent. You talked about sort of, coming to Nigeria and finding yourself more optimistic about the country than sort of those of us who are actually on ground. So you're looking at, you do work in East Africa, in West Africa. So what are your perspectives on those two markets in terms of how do you feel about, the things that are on ground? What are the differences you do see? What's.
It's hard for me to believe that it's the same continent.
Okay.
So it happens to be technically, but, there's a lot a lot of differences between the markets. I think what companies underestimate is the risk-adjusted cost of expanding from one end of the continent to the other. I can't tell you how many Kenyan companies have on their roadmap, especially when they're raising the kind of money we help them raise. So if they're raising $30 million plus, by definition, they're internationalizing.
Yep.
And I can't tell you how many of them have got Nigeria already specced out in their plans and are going to spend $5, maybe $10 million on Nigerian expansion, and they really don't know how to do it. And by the way, the reverse is also true. So, and the challenge in both of these markets is that the adjoining markets are small. And, I mean, when Nigeria, all the rest of West Africa is 50% more than Nigeria. And you see similar thing in East Africa. And so, from my point of view, for somebody to be able to build a regional, i.e. West or East African business, I don't know if it's straightforward, but at least it's clear enough. It's just hard to see how you can build a $100 million revenue company in any tech-enabled space doing that. And so the idea of having to go across the continent and do it successfully is non-trivial. And I think in terms of experienced CEOs, there are quite a number of experienced CEOs who don't quite know how to do that yet. And, it's still in the front windscreen, if you will, because for a lot of companies, they haven't gotten to that stage yet. But if you were raising money at $100 million plus valuation, you're raising money to be, or at least aim to be, an African business in one way, shape, or form. And this is one of the biggest issues that companies face trying to expand beyond certain size. Because let's not mistake valuation with revenue. If you look at the global SaaS industry, right, the number of $1 billion plus valuations is dozens and dozens and dozens. You look at the number of global SaaS companies over $1 billion of revenue, there's a tiny number. Yeah. It's much harder building a company of scale than getting a high valuation. Sooner or later, obviously these companies have to grow into their valuation, and many of them have raised money over the last 2 or 3 years at prices that demand that they hit 50 million plus of revenue. And that means going across markets, and it is a different continent on the other side in many ways. It really, you can lose $10 million in Nigeria easily.
Yeah. That as a CEO, that gives me highs. The thought of going into a market and losing that kind of money sort of in a snap. I guess it's going to be because I see a lot of the fintech companies trying to do that expansion across the continent. And I wonder if them being able to solve some of those problems will make it easier for other companies coming behind them. There will still always be regional issues and differences to deal with, but at least being able to extract value from the market in terms of being to pay for your goods might, and the lessons that they will learn might be useful, for people coming behind them. Does that ring true or no? Not necessarily.
Well, yes and no. I understand, but there's relatively little margin for error in Africa. There are so many issues associated with scaling companies, and I don't mean that in a terribly negative way, just these are issues that companies face. And so there is a requirement to be able to convince investors who are anchoring $30, $40 million plus rounds that there's a clear path to executing. If the first group of companies in a market sector don't do it well, all that's going to do is set everybody else back.
Gotcha.
So, the domino effect is much greater, which means that it becomes really important for those companies that are going first to have the infrastructure and management depth to be able to do it. We know almost all of them. I'd say it's about 50-50.
Gotcha. Let's jump into doing deals because I think that's what half the audience is here for, is to talk about how you actually get a big deal done. So I guess I'm going to ask, again, a broad question. At one point, does a company start talking to an advisor like Magister about, we're looking to raise or we are looking towards an exit? How, when and where do you come into a company?
So it should be 6 to 9 months before they press the button.
Okay, all right.
That happens about 25% of the time.
Okay.
The way it currently happens is 9 months before it's 25%, 5 months before you cross over the 50%,
Yep.
And inside of 3 months, it starts to go to 100%.
Okay.
I used to teach exit and large round preparation at INSEAD Business School for 6 years. I can tell you that it probably should be at least 50% in the 6 to 9 month phase, i.e. allowing 3 to 4 extra months.
Gotcha.
And I know it's hard because there's so many, commercial problems that companies have. I know it's hard because frankly, you don't want to think about it till you have to think about it, but it is a chronic mistake that companies make. And the question is, why is that a mistake?
Okay.
It's a mistake because a lot of times the companies have already built up a track record over a year or two of positioning their business a certain way, using certain KPIs and metrics internally. And so just to be very prosaic about it, they have a year or 2 years worth of board packs that set out the business in a certain way. Somebody like us comes in, looks at it and says, actually, we ought to look at the equity story differently for these reasons. But all of the history is baked in already. And then what you don't want to do in terms of new investors is make it look like you're doing the proverbial expression in English is putting lipstick on a pig.
Gotcha.
You're not just sort of, doing hygiene, but actually the company's aligned around this equity story. And equity stories can be very different than companies have had in the past. Markets evolve, companies evolve, strategies evolve. And so there just is an essential amount of time required behind the curtain, if you will, before anybody does anything towards an investor. That has probably lengthened as a result of COVID. People are more skittish. They want to know more. There's more certainty required in delivery of numbers and messaging. So it becomes even more important. But there are two big mistakes CEOs make. One is that one. The other mistake is how much time should they allocate to preparation for a large round or an exit in the 6 to 9 months before. Our guidance is 15% of their time. I can guarantee you that only 5% of CEOs I've ever worked with allocate 15% of their time 9 months before a transaction starts. Not ends, starts.
All right.
Yeah. And probably 75% are 0 to 5%.
Gotcha.
And, I know you have to take time from somewhere. You have to steal it from somewhere and it has a cost.
Yeah.
But especially now post-COVID, when the bar is higher for everybody around the world, there is so much more effort that's needed behind the scenes before companies engage with investors. Put another way, the tolerance for things not being quite right today is a fraction of what it was 6 months ago.
Gotcha. So it's the investors are tougher, the expectations are higher.
Yeah. But it can get done. I mean, I mentioned to you, we have 3 rounds going on now in early stages in Africa, companies looking to raise $40 to $50 million plus of new equity, and a 4th one probably coming on fairly soon. And all of those are decisions being made based on the underlying health of those companies and the fact that, through COVID and now, quote, post-COVID, they're seeing their businesses grow quickly enough and gain enough share that they feel confident to be able to do it. So companies that are reference companies in the ecosystem are making decisions to go do this. This is not a kind of, oh my goodness, I'm a deer in the headlights, I may or may not succeed. This is just doing the preparation required that other people are already doing in order to succeed in 2021. But there's more work to do. You just have to work harder.
Gotcha.
Sorry.
So 2 questions related to that. So you're seeing big equity raises right now. So people are still optimistic about the future. People are building and they're optimistic about the companies they already have. So the value that's already been baked into those companies, they can see a pathway where if I raise $50 million, I can build a sizable company on the back of that. Fantastic. So I'm going to then switch to ask the question about exit, because that's been the big sort of question around the ecosystem. Where the exits? We're starting to see some of those. What are you seeing? What's your perspective on the exits that have happened, whether by acquisition? What's your perspective on the market right now, exit-wise specifically?
There are 3 types of realistic exits.
Okay.
One is strategic buyer. The second is a control deal from an African private equity firm.
Okay.
The third would be a version of that, which would be a control deal from an international financial sponsor that maybe also has other assets elsewhere, but wants to do a bigger play than a regional expansion. Now, those last two are obviously twins of each other, but they are fundamentally different. So let's maybe deal with those. So first of all, when you look at technology-enabled businesses worldwide, 50 to 60% of all exits are being done by financial sponsors now. The number one buyer in the world is Thoma Bravo, which is a private equity firm in the US. It's not Cisco or Apple.
Gotcha.
So that is a market shift that's already happened everywhere. So one should not be surprised that that also reads across to Africa. The reason that's in a different category than African private equity is because very often those companies, and Thoma Bravo I'm picking on, specifically, is they're not looking to value a company based on EBITDA multiples. Yeah. So they're looking for growth. And as long as a business is break even or profitable, very often they're happy to pay up for growth and will buy 50% plus for growth of a company. African private equity typically values businesses on EBITDA. And then of course you get strategic deals like Network International and DPO, which just happened. Which, by the way, Network International paid $300 million and did it all entirely over Zoom.
Oh, wow.
Right?
Wow.
So if you're thinking it's not possible, it is. They never met. So the two financial sponsor exits, the African private equity, let's move to one side because that's traditional. Typically, they're not the highest multiples of EBITDA, and oftentimes growth companies don't have enough EBITDA to even qualify for that, but it's possible. The international private equity firms, there needs to be a bigger story than just I'm going to be a leader in East Africa, because you're talking about Warburg Pincus or General Atlantic or whoever buying 50, 60% of a business. They would only do that if there was going to be a broader multi-continent expansion, if they had an existing portfolio company in another geography that could also knit with an African business. Or, for example, there's an opportunity to grow from sub-Saharan Africa into MENA, et cetera, and there's a credible path to do that. But they pay multiples of revenue, not multiples of EBITDA. In terms of strategic buyers, there's more work to do to engage them with African businesses. I maybe would use the example of PayPal just as one, because PayPal has kind of been interested in Africa, as you know, for quite some time, but it's very hard for a company like PayPal, I'm not picking on them, to buy 7 African companies in 7 different countries and, quote, knit them together. They're looking for a platform to acquire. They're looking for one company. And by the way, I use a DPO example. It's a good one. I mean, DPO was as African a platform as you can get in core payments. And they were really only in South Africa and then also a base in Nairobi. They operate in other markets, but it's not like they were very big in West Africa. So by no means a Pan-African business, but Pan-African enough that they could evolve credibly, or at least argue they could evolve credibly into an African platform. And so being able to, what does a company need to do to prove enough reality in terms of an African platform to qualify for a strategic buyer? I mean, that's a much bigger discussion, but that's what they're looking for. They're happy to pay $400 million, not $150, but for a business that already is getting there rather than one that they have to invest in and help to get there. I mean, you're talking about market caps of 50 to 100 billion for these buyers. The difference between 150, $400 million, I don't mean to trivialize it, but it's nothing compared to the risk of failure. So I don't include IPOs here. IPOs have been mooted. They're really available for a very small number of companies. It's not a well-trodden exit path. And actually, even in Europe, 90 to 95% of successful growth companies exit by M&A. They don't exit by IPO. So it's the same everywhere. I think there's an African content overlay to this, which is that companies that might want to be bought for a strategic price, not just being picked off by somebody, will probably need to do a degree of preparation and courting with potential strategic buyers for a longer period of time and really engage with them so that they become an obvious acquisition target. There's more courtship required because it's further away. And it's still more, quote, exotic. And therefore, there's just more effort needed to be able to convince a strategic to pay a strategic price. Nobody wants to convince a strategic to pay an ordinary price. That's not the point. So preparation for a strategic deal is typically 1 to 1.5 years before you press the button on the process, not do it. Press the button. And for a financial deal, it's probably a year also. I mean, these things, I wouldn't underestimate them, but you know, if preparation didn't pay off big time, I wouldn't keep preaching it.
Fair enough. Let me ask, so what is that, you're looking to do, you're thinking about exits. You've built a company that's fairly sizable, you're doing, I don't know, 5M in revenue, 10M in revenue, whatever it is. You're thinking, how do we exit? When do you start to have these conversations with prospective acquirers, prospective people? What is that process?
Sure. So first is you focus on corporate marketing before you talk to anybody.
Okay, what's corporate marketing?
So what's corporate marketing? It's there's an equation. It's a very complicated one, so bear with me. It's called perception minus reality equals value.
Perception minus reality equals value. Okay.
That's not spin. I know it's complicated, so maybe take a moment to digest that. But obviously it's simple enough for a 5-year-old, right? So and perception is not spin, but perception is what does a buyer think about a company? What have they heard about a company before anybody approaches them to do anything? Okay. And what you want to try and do is get in the buyer's minds, oh yeah, I've heard about it. I'll give you an example from decades and decades ago, because this hasn't changed. So there used to be an email, when there was actually email companies, there used to be an email company called Hotmail. Okay, you probably recognize this. And they did a very specific kind of corporate marketing. There were 4 or 5 publicly traded email vendors at the time. They spent all their marketing dollars to get into analyst reports as the only private company covered. So you have analysts covering 5 public email vendors and Hotmail. Well, it turned out that, I can't remember if it was Bill Gates or somebody else at Microsoft read a bunch of these reports, said, who's Hotmail? And then $400 million later, they acquired Hotmail. And so, they didn't know anything about Hotmail. And so, being able to broadcast the company, but not what the company stands for, where it's going, what it does over a period of time, getting into articles and things that very well is kind of home territory for you, that kind of thing is essential to be able to create the broader perception for a business. CEO maybe selectively being an expert in his or her area publicly. There's a lot of that goes into it. I used to write for the Financial Times years ago. So I guess for me, it's sort of home territory. But for example, in the FT loves to write about high quality African businesses that are going somewhere, much more than they would be interested in writing about a Danish company going somewhere. Right? Yeah. So, there's an awful lot of differentiated opportunity that African companies can take advantage of that other companies in other geographies wouldn't. But that's just one example. But the point is building that perception well before anybody talks to any buyer. Because what you want is to win the aerial war, if you will, before you do the ground offensive. Gotcha. And going to engage with buyers is the ground offensive. And the aerial war doesn't get won in a week. It's a few months. Many companies think about this, of course, but the mistake they make is that they will do a few press releases and change the website, etc. But what they miss is the whole context of who are we trying to get to here? This is all home territory for you. What's the audience? How do we get there? How do we get into their mindset? How do they hear about us a few times, etc. And then you begin the ground game.
Gotcha.
So what's the ground game? Okay. One is commercial deals with companies. Yep. We very often encourage companies to do commercial deals that they might or might not otherwise do purely commercially, but with a self-serving intention to collaborate. We have a deal with a European company going on at the moment in AI, where it's a Far Eastern potential buyer that's worked with them for 6 months on a specific integration, fallen in love and decided they would like to get married. And they're going through the whole process, and this is going to be a strategic deal because they're not convinced of the value. And so you can't do it with 15 companies, because if you're a small business, you'll die doing it. The CEO can't spend 80% of his or her time on this. So one needs to pick their targets carefully. But being able to do that, on a concerted basis with a small number of the best buyers, all you need is one of them being seriously interested, and you can build a competitive M&A process around it.
Interesting.
So you don't need 7. And that takes a chunk of time. One of the big mistakes that CEOs make very often is that they will kind of do very limited outreach to companies, or want to do basic plain vanilla commercial deals. And to them, they think, oh, okay, well, we've got a relationship. Of course they don't have a relationship. And means nothing when they get approached as a potential acquisition.
So let me pause you if you don't mind. A question I was going to ask was, what percentage of acquisitions happen with the acquired company reaching out to the acquiree versus vice versa? But listening to you speak, it feels like you go to them and look for a partnership, look for a commercial offer. You start to build a relationship by looking to do business with them. And in a sense, you show them the path to the value in your company.
Yeah. You don't want, ideally, you don't want to ever go out to anybody to sell yourself.
Gotcha.
Companies should be bought, not sold. Now, to be bought, not sold requires an awful lot of upfront selling. You just don't call it selling.
Interesting.
Right. And now the other thing is also, being bought, not sold means getting interest from a strategic buyer that then you can leverage, because if you're going out to other people, you can very clearly go and say, look, we have a buyer at the table. That forces the whole process. And it's amazing how quickly other buyers respond when you have a credible point. Of course, you can do it and lie, but generally it's a bad idea to blatantly lie to large companies about something or other, right? Yeah. So, you normally want to be able to do it with credibility. And the whole idea is to be bought, not sold. So I don't remember the last time that we actually set up a sale process without a buyer at the table, and went shop the company. Normally what happens is that, we spend a lot of time behind the curtain trying to engineer this kind of interest, develop it, coach the CEO, and, that never sees the light of day. We don't want it to, but what it does is it creates the weather conditions for the potential of being bought, not sold. And that makes the price entirely different. It must have been 20 years ago, the last time that we ever, quote, wrote a book on a business and sent it out to 30 people to be acquired. It just doesn't work like that anymore. The nature of our business has fundamentally changed from even 10 or 15 years ago. Our business is advisory business. It used to be a distribution business. Distribute a particular company as an opportunity out to buyers. It's not a distribution business now, it's a product business. What I mean by that is distribution is much easier than, and I probably, on the one hand, I'd love to say, yes, we've got differentiated access to large buyers, and we do. We've done 3 deals opposite Apple, for example, and we know them as well as anybody in the world. But, this value of distribution is a lot less than it was 10 or 15 years ago. The product value, how the company's packaged, how it's positioned, what the perception is before you go in, the product value has grown 10x in that time. It's a product game, not a distribution game. And there are many, many, many people in my profession who don't get that.
Gotcha. So what kind of things come up in an acquisition conversation? What are the things that trip up the process? What are the things that make it go super fast?
How many hours do you have?
In brief, give me top 3.
We should do. I should do one of. There's a masterclass. I should do a masterclass series and sell it for $15 an episode or something. But I can milk this one for a year. In a nutshell, over complexity.
Okay.
What goes wrong? Buyers will pay more for something simple.
Okay. And that's simple in the deal or simple in the company?
Simple generally. Simple equity story. Simple to define. Simple set of KPIs. Simplicity. The biggest mistake that CEOs make is in the interest of being able to build a relationship, a real rapport with a buyer, they will overcomplicate things.
Okay.
Now, by the way, it gets worse. There's an example from a company we successfully sold in Sweden, of all places. I don't know how much you know about Swedish culture, but it's a very transparent culture. So we had a situation where the buyer had all of their team in a room doing due diligence, asking questions. We coached everybody on the company side. And then the CTO at the end of it says, you know what, you guys asked some very good questions, and I know we gave good answers, but you really should have asked about X.
Oh no.
Right? And he said, I'm surprised you didn't ask about X. I'm sitting there and I'm trying to push my chin back up to my thing. And the CEO, I think, I'm really glad there was, you can't get a firearm easily in Sweden, right? And he proceeds to lay out X that they should have thought about, which by the way, they thought about, but didn't think about it in that way. He gives them a whole new way to think about X.
Oh no.
Okay? Gives the whole process drags for 4 weeks. The documentation has 2 extra pages of warranties and reps around X. Actually, frankly, I've forgotten what X is because I put it out of my mind the minute the deal closed. I never want to remember it. But it was so palpable, the feeling of, oh my God, what have we done? So if you relate that, but if you relate that to CEOs, everybody, probably a bunch of people on this call are smiling and maybe laughing, but if you relate that to something very pragmatic, I talked about board packs earlier. So I can't tell you the number of times we see board packs so full of transparent information, so full of here's all the things going wrong. You know what, guys? These are all discoverable in due diligence.
Yeah.
First thing a buyer is going to do is ask for the board packs. Why? Because it's their second information memorandum on the company, and it's the real one. And, the stuff that's going wrong in Malawi, wherever, that you really didn't want to talk about, guess what? We're going to talk about it. And on and on. And that's just one example of...
You don't want to lay out that problem up front. You don't want to lay out that problem up front. You want them to get into a deal they like.
Nobody's lying. Nobody will lie. And nobody will hide anything. But it's all about packaging. Yeah. And, these, what I'm just saying is those are kind of examples of things that kill deals because there's just too much detail disclosed. I'll give you another example. Unit economics. People talk about unit, and maybe some people on this call know what that is, but it's basically, what is the cost to acquire a new customer, service a new customer, how long are they a new customer, how do I make money on a new customer? Yeah, and that walking that journey on a per customer, per year basis. Okay. So getting down to the atomic detail of looking at each individual, not each individual customer, but averaged over customers, so that I can see that you're a profitable engine, even if you're losing money as a company. So unit economics can be done simply or more complicated. It can be done 100 different ways. A lot of particularly financial sponsors, investors, want to dig into unit economics. There's no shortage of different ways of calculating it. If you give a financial investor who wants to buy 60% of the company, if you give them all the raw data, they will get completely lost because things go up and down and up and down and then go sideways. And then the complexity is dramatically damaging. So what you want is to be able to package that so people can see the forest, not the trees, if you will. And so that's just one simple example of how packaging can help reduce complexity. And you need to tell an equity story simply. It's not just the elevator pitch of a sentence or two. It's also the simplicity in the deck, the simplicity in the messaging, etc. Because people pay more for simplicity. Even if they ask for all the complexity, they don't really want it.
Gotcha. All right, let me ask you first question. What does it take to qualify for a large financing round, equity financing round? In simple terms, what are the simple things that, an investor is going to say, okay, I can put some cash into this, what are the things?
Could you maybe ask me like my name and where I am and stuff? Start with something else. What does it take?
Just broadly.
Yeah.
What are the key indicators that
okay. So the answer will be for rounds that are $30 to $40 million plus of equity.
Okay.
But just because they have to define large round one way or another.
Yeah.
Number one is having a handle on a company's unit economics and being able to explain that in detail to a potential investor. When you get to that size round, investors really care more about that than anything else. I had a meeting with several partners at Accel Partners might have heard of them. They're based in the Valley and also in London. So it was in London. It was for European business. And several of the senior people at Excel came in, and I'll never forget what one of the partners said. He said, look, I don't care if you sell software or milk. All I care about is to see your unit economics. If they work, they work. If they don't, they don't. Yeah.
Gotcha.
And it's an interesting way of looking at a business really from the inside out. Now, the issue there is unit economics is an art, not a science. I mean, again, this is going to go now into my new masterclass at $15 a session, but it isn't really an art. And you need to be extremely careful about how you present it and also being able to back it up. But at the end of the day, if I look at the biggest gap that African companies have trying to be well prepared for a larger round, it's really having a handle on the unit economics, stress testing them, looking at them in comparison to other companies that an investor will have looked at, maybe in other geos. What does good look like? Yeah,
Gotcha.
That is far and away number one. Number two, boy, it pales in comparison because of some of the other issues. I mean, the deep team and blah, 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 all of that is really, I don't mean to dismiss it, but it's, it's fundamentally important. I think the second thing is being able to demonstrate momentum in the end market.
Okay.
When I say that, I mean that either the market is wide open enough or it's moving enough. And so therefore, the argument to an investor is, look, Mr. Investor, usually it's a Mr. these days, it's changing slowly. Look, Mr. Investor, all you need to do is put money in and it's just add water. Turn the handle, the market momentum is there. Being able to, having to manufacture market momentum, it's tough. And also, because if somebody's putting that kind of money into Africa, they want to know that certain risks are off the table. FX is, devaluation is a risk. Stuff going wrong is a risk. If you've got market momentum with you and that risk is off the table, it counts for an enormous amount. I would say, in the spirit of trying to be as simple as possible, if you have those two and are deficient in others, you've got a good shot.
Gotcha. What are the big risks people look at for Africa deals separate from other deals? And how do you get over them? How do you help them get over them?
Again, I'm still prepared for the question, what's my name and where am
I know.
What do they look? Okay. Number one is foreign exchange adverse effects. I'm not doing this prioritization, but just a list of things. Number one, so the first one, a lot of investors work on a 6 to 7% adverse FX rate. What that means is they assume that across a basket of currencies and geographies in Africa, that there will be a negative 6%. Now, it's not negative 6% in every country, but that captures Nigerian devaluation, etc. Okay?
Is that negative 6% annually or over the lifetime of?
No, annually. Okay,
annually.
Which means that in their assumption, 40% growth is really 34% growth.
Okay.
On a dollar basis. Yeah.
Okay.
So that's important for all African companies because that also means you need to grow 6% to grow 0.
Yeah. Okay.
So that means that growth, and typically investors will not look at growth rates less than 30, which means you typically will need growth rates of 35% plus in Africa. So that's one difference that people look at in Africa that they generally don't or to the same degree elsewhere. The other thing that they should look at but don't, is what they look at is capital efficiency. Okay. And they look at that everywhere, but they're worried about it in Africa. Why? Because the first $5 or $10 million you raise, you quote waste on being vertically integrated. So, now what you need to be able to do is guide them to say, well, look, guys, the first $7 million or whatever was quote wasted, but the benefit we're getting for that is that we have much higher take rates and much higher long-term take rates than we would have in other geographies as a quid pro quo. So being able to demonstrate the rising take rates and a differentiated on a higher take rate is something that is particularly important in Africa versus other geographies. And the reason for that is that usually in other geographies, companies are trying to work on much bigger scale and then take much lower margin.
Okay.
But in Africa, you don't have that scale because it's hard to build out in different geographies. So you need to be able to show a much higher take rate as a result. Now, very often international investors don't value that highly enough. And frankly, they undervalue it. And very often what they'll do is they look at it and say, oh, that's not sustainable. I don't know, you're getting 6% margin on these kind of mobile money transactions. In Brazil, they get 2%. You're going from 6 to 2. Yeah. But in fact, you may be going from 6 to 7 because you build a bigger and bigger position in the market. And so it is very possible that it goes the opposite direction of investors, and their assumptions about take rates are entirely wrong. So they look at them, but very often they're wrong. And I don't mean it wrong in the sense of they don't know what they're doing. It's just a question of appreciation of the potential, especially for investors that have not done deals on the continent repeatedly and therefore don't have all the proof points. And that is actually the holy grail, because what you want to be able to do is raise that kind of money for an investor who may have dabbled on the continent or not yet even entered, but who is interested, for example, in a particular sector, or who is interested in a particular theme. And by the way, I mean, we've been able to show that. So late last year, we worked with a company called Cloud Factory, which has 3,000 people in Nairobi, and by the way, 3,000 in Nepal. They raised $65 million from FTV, which is a New York-based investor in fintech. FTV had never done an Africa-based deal before. This was the first ever. $65 million was the second largest round raised in the world in their space, not in the continent, in the world. And so it is very possible to get a first-time investor to do an international round into the continent. It's just that they need to be able to appreciate the value of the money that was wasted initially, not just look at that equation. The third thing, and I'm going to stop after the third thing, is that investors have a very wide spectrum of appreciation and view about international expansion. Some view it as essential to build out a platform. Others only look at the negative of the incremental cost.
Okay.
So there is a uniqueness in looking at companies on the continent, in that if companies can go to an adjacent market and show that their cost of building out a certain size customer base is materially lower than their home market, meaning the learnings from the home market can be translated to a new geography, that's a proof point for positive EBITDA economic expansion, which a lot of investors are particularly concerned about. Well, given the fact that if you're trying to ship something from Nigeria to Ghana, it costs more, I think, than putting it on a boat and sending it to China.
It does.
You know, so I mean, they have good reason.
Yeah.
You know, very good reason. So the point is to be able to front run that by being able to show that actually the reverse is true, which, by the way, companies have shown they can do that. They can go from one West African market to another and be able to demonstrate the value of learnings repeatedly. We've seen it in a number of sectors. So it's definitely possible, but can't overestimate the importance of it, because otherwise people have their own built-in bias.
Gotcha.
And you can't really overcome that very easily.
Okay. I'm taking questions from the audience now. I've got a bunch of them. I think we've got about 30 minutes left. I have really interesting questions phrased in two different ways. One from Roseanne Wally, and Daring Sola Adebayo has also asked a similar question, which is, what is the role of earlier stage investors in terms of setting up a business for a large future round? So there is a bit of a, you're investing and you want to get your exit out in 3 years. What are the things that you need to be doing as an investor in setting that up?
Yeah, well, if I could, maybe I could talk about what could go wrong if I do that, because avoiding things that go wrong is usually a good starting point for, doing things that are right. So what are the biggest mistakes that companies and investors make that set them up badly for a large round? So I've reframed the question. Number one is complexity in the cap table in terms that is totally unnecessary.
Okay.
And what I mean by that is that we're still in the stage in African financing where earlier stage financing is a lot about structuring instruments, rights, interest rates, et cetera, all of which is maybe necessary for the first stage, but becomes very unnecessary later on. So now it's easy for me to say that because I'm not the one fundraising, $3 or $4 or $5 million to get a business going, but there's an enormous value in simplicity of structure. The second biggest mistake is that everybody joins the board.
Okay.
And in which case, if I'm coming in with a $40 million check and I want to have 2 board members, and I expect that to be like 2 out of 5, I have a 7-person board already waiting for me.
Gotcha.
Big problem, because I don't want 3 board members or 4.
To fight with.
That's too many. And why are all these people around the board?
Yeah. Okay.
And by the way, it doesn't help you to have observers rather than board members, because observers means the room is packed.
Gotcha.
So now I know that means that there's hard questions to be asked and answered.
As you're doing a round, is there an option to say, look, as a condition of this round, we're going to remove X?
Yes. Yeah, there are many mechanisms to do that. One is, if you, as an investor who have a board seat, are not putting in new money, you don't get to keep your board seat, for example. There's a lot of ways of doing it. But, having that clear so that you already know, it's going to be a 5-6 person board, it's going to be 2, et cetera. And again, it's part of the simplicity point I made earlier, but solving that problem early becomes really, really important to do. I would say I found earlier stage investors generally pretty helpful to companies. The CEOs need somebody to talk to. There are many, many cases where earlier stage investors have become really mentors in a way to CEOs. There's a limit to what you can do, because you have your money in. So being a real mentor is not possible. But there's still a very close relationship between quite a lot of CEOs and their investors. I think where you have the biggest problem is impact money.
Okay. What's the issue with impact money?
Issue is that you've got a fundamental divergence of what good looks like beyond a certain stage of a company's development. And I'm saying this in a very black and white way. It's not necessarily the case, but what you find is impact investors who have supported a company and legitimately are entitled to be recognized for that. For them, they want to see, more schools covered, more hospitals covered, etc. Whereas CEO looking to raise $30-40 million, we're way beyond the stage of impact money. Impact money generally can't follow. You need commercial money. And when you need commercial money, then you have to be careful that the existing impact investors are not creating an issue. They've been pushing the company a certain direction to solve for mission metrics, which are great, and that's why companies get into business. But it's not good enough to be able to raise commercial money. And the commercial investors also get an issue of what's the mindset of this company? Is it commercially minded enough? And so being able to graduate mentally and structurally beyond impact money before you raise a larger round becomes oftentimes fundamental. And look, the reason is, as I said, because impact investors simply can't write $40 million checks. I mean, most of their funds are only $40-50 million in size. So excluding the very big ones. So you don't have a choice, and that is something that the commercial investors really watch out for when they look at doing these larger rounds, particularly with companies that have had a lot of impact money relatively up to that point. So those are just some of the takeaways. I have about 400 others, but let's keep going.
That's easy. I've got a great question from Victoria Cranley. Hi, Victoria. I want to know that, look, she says brand marketing is an important part of packaging. How do you persuade an African tech CEO who are often founders, the left brain, the engineers, about allocating capital to something like brand, which isn't sort of very easily quantified?
There's not enough ROI to justify it. So there's no point having the discussion. I'm sorry, being flippant here, but you understand the point, right? The only way you really look at it is you're allocating a certain amount of money to buy insurance for your next round.
Okay, right.
Now, there's an awful lot that goes into how that money is spent. Just being able to allocate $50,000 or $30,000 or whatever to brand marketing doesn't mean that it's going to be well spent and you're going to get success. And by the way, also, bear in mind, we're not talking about, money that's kind of radio locally. We're talking about generating, an awareness level that is further afield. And so it requires more money. This is where the issue is, because it's not $10,000. It's a multiple of that. And so that becomes a very expensive thing. I'd make a couple of arguments. One, you don't have to do it for 5 years. If you're doing it for 5 years, you're using somebody else's money to do it. You only have to do it for a year, number one. But you do have to do it for a while. Number two is it's going to cost you 2 to 3 times what you think it's going to cost you. And 3, the biggest cost is not the money. The biggest cost is the CEO investing their time and committing to doing it, which many CEOs think, well, I'll do it, until they don't do it. But if you don't believe it's buying insurance in the next round, and if you don't believe that it's a fundamental part of preparation, then you can spend $1 million. It doesn't make any difference. What are you going to do? Get an ad in the Super Bowl? I mean, it's not that. You can't outsource it in the sense of relying on any third party alone to do it. You also can't do it on your own, but that's a different point. But if you're not prepared to commit the time, but I'm telling you, I've been doing this 30 years. I'm on deal 130. If I wasn't banging on about it, I'm banging on about it because it's so important, not because I like it.
Gotcha. So it's insurance for your next round, and it's absolutely critical to getting that next round done. That's
first question we ask a company when we're looking to work with them is, what is your corporate marketing plan? And generally the answer is, what do you mean?
Yeah. Okay. But Victoria, I think that I hope that answers the question.
I couldn't be more clear.
Gotcha. I've got a question from Bukola Bolariwa, who wants to know how investors see and manage regulatory, political, and policy risks for African companies.
Oh, geez.
Questions, lots of small questions.
Okay. Regulatory.
Yeah.
Well, there's certain sectors where there's so little regulation, it's really surprising. There's others, mobile payments is one, where, and compliance related and certification, licensing, which become a source of value. So, they're kind of, it's a barbell thing. Certain things are essential, like, you need to wait a certain amount of time to get licensed in Nigeria. And so that amount of time is value to a company that already has a license. Two, there's just literally no regulation for things that in other markets, being perfectly honest, you would assume there would be regulation. So it's pretty broad. So it really has to be very sector specific. Now, as far as overall political risk, we've seen it come up with certain investors in Nigeria. And investors, no matter how much they think about Nigeria as an opportunity, they would like a company hedged elsewhere in West Africa so that there's a bit of a de-risk. Yeah. Unfortunately, and I'm not picking on any country here, the one medium to larger size economy in Africa that people consistently have a concern that they need to get over in terms of political risk is Nigeria. It's possible to get over it, for sure, but it's the only large market. So Kenya, less so. Maybe they should, but they don't.
Okay, gotcha. Interesting.
I don't make the rules.
Gotcha. I live in Nigeria, so it's
yeah,
Yeah.
It just means a little bit more work in terms of positioning, a bit more work in terms of market opportunity. One of the other things, for example, about Nigeria is a lot of incoming investors or buyers don't understand just how deep the market really is. There are parts of the market that are much, much deeper than people realize. I think it was not too long ago, the remittances totaled more than oil.
Yeah.
So if you're in the remittance business in and out of Nigeria, you have a bigger market potential than the oil sector. I'm just using that as maybe one flip example. There are spaces that are very, very, and also distributed energy in Nigeria. The grid is so bad, and many people on this call know, the opportunity for distributed energy, albeit at a high cost because you don't have a good enough grid, but the opportunity is huge. It just is hard to make money in the first year or two. I get that. But there are opportunities in the market that are untapped, that are literally wide open, that just don't exist elsewhere.
Gotcha. I think
That's why I'm always the most, that's why I told you, like in any room of Nigerians, I'm always the most positive person.
Yeah, you did mention that. So basically, the answer to that is, look, the regulatory risks are going to be there, but the opportunity is so large that, look, returns will sort of exceed.
Yeah, but part of it is not just saying the opportunity is large, it's also being able to show international investors what the exact opportunity really is. You know, I quote a few stats, I'm like, I don't know as much as 95% of the people on this call, but you know, I quote a few stats from my observations being in Lagos a whole bunch of times to people, and I can't tell you how many international investors are completely shocked, had no idea.
Gotcha.
You know, like, wow, I didn't know that. That's a big market for that to happen. It's just that kind of basic learning, and you know, they're smart people. They get it fast. They need to be guided.
Okay, great. What drives valuations in Africa compared with Europe? That's a question from Osato Guabadia.
Well, unfortunately, many equivalent, and I use that word in quotation marks, many equivalent companies in Africa are more highly valued than they would be in Europe.
Okay.
And the reason it's supply and demand imbalance. There are many fewer companies of a certain scale in Africa, and there's money available to invest in them. The second reason is that impact money has historically been more price insensitive than commercial money. Yeah, because as long as you're committing to do a social good. Third is that, and I don't mean this in any disrespectful way, but African CEOs who build companies up above a certain size have been allowed to get away with stuff that you wouldn't be allowed to get away with in Europe. And what do I mean by that? You know, they have 3 or 4 different lines of business. It's not as focused. Now, of course, you need multiple lines in an emerging market, but they typically will do a whole bunch of different things, or oftentimes that frankly reduce value rather than increase value. Whereas in even a small market in Europe, at this point in time, companies wouldn't be allowed to do that, right? And so, companies, like let's say you're doing $10 million of revenue from 4 or 5 different lines of business, 2 of which are not that highly valuable, you get earlier stage investors in Africa often valuing the 10 million with 1 multiple. Whereas in Europe, nobody ever would.
Gotcha.
Yeah. So, and fundamentally, it's a supply-demand imbalance. There's just too few companies above 10 or $20 million of revenue, and so there are not that many to choose from. That is changing quickly. You know, last year, 100 companies on the continent raised $1 million. That's a big number, and so roll that forward, and 25% will raise a Series B in 2 or 3 years, et cetera, and then you get another cohort. So the supply-demand imbalance is going to reset, but I don't think that's a positive. That's a negative. All it does is create problems for raising a larger round. I mean, if you raise a $5 or $10 million round and raise it at 2x what a company otherwise would be, quote, worth, all you've done is create a huge problem for yourself. The dilution that you saved, if you will, on the 5 million being at a high price is nothing compared to the angst you're going to have later on when you try and convince an international investor doing a large round that really they should be paying a $250 million pre-money valuation when they look at it and say, there ain't never been an African company in your space that's exited for 250 million, let alone funded for 250. If I fund you at 250, you need to be worth 750 for it to make sense to me. Name me the exits that have happened at 750. And the answer is there aren't any. And so the answer is you back solve for no interest. So the same enthusiasm you might have successfully raising 5 or 10 at 2 or 3x your intrinsic price is exactly the same reason you will probably be taking a bath worrying 2 or 3 years down the road why a bunch of key investors bailed on doing a larger round because it was so ridiculously overpriced. I'm being extreme, that they couldn't convert. And by the way, they apply the Africa risk discount to it one way or another, and they simply can never get there. The way to look at this is the following. If you're raising $30 to $40 million, okay, nobody cares about working forwards from your last round. No one cares. They only care about working back from an exit. And so whatever price you want for the company, no disrespect to anybody in the call, does not matter. There is only one thing that matters. And that is I, as a new investor, want to get 3 times my money or more on an exit at a realistic price. Let's do the simple math. okay? $100 million valuation pre-money. I'm raising $50 million you're raising $50 million for me, okay? That means my quote post money is 150 million. Bear with me, the math stops in a second. I, as the investor, want to see 450, okay? Which is 3x over, say, 4 or 5 years. So I'm gonna look you in the eye and say, what are we gonna do credibly and realistically with an Africa discount, with the headwinds and friction we have to make this company worth 450? You're gonna try and convince me, okay? Yeah. I'm gonna take a view. If my view is, actually, you may never get there, but you could be worth 250, 300. Remember, DPO, which got all the press, sold for less than 300.
Yeah, 288.
Okay? Right. So let's say, oh, you're going to do a DPO. That's 300. I want to get 3x. That means the post money can't be more than 100. Gotcha. Otherwise, I'm not coming in. If you're raising 30 for me, that means your pre-money is 70. Not what you want it to be, but that's the price in order to convince me. Otherwise, whoever I may be,
just don't.
Why should I be interested?
Gotcha. Fair enough. I'm going to
be very careful with valuations.
Yeah, no, I think that makes sense. And that's definitely valuable stuff for founders and investors here to think about. I've got someone, Tipitokwe Ekundayo. I'm going to let you come live to answer your question. Tipitokwe. Okay, I'm fine, Tipitokwe. So he's also asked another valuation question, so I think he's dropped off. Actually, no, I'm going to let Donyi Bagamosi answer the question. Larry, can you let Donyi live?
I hope this is helpful, by the way.
Sorry?
I hope this is helpful to everybody.
This is super useful. There's lots of comments about how useful it is. And there are lots of very, very interesting questions that are not, what color is your shirt?
Well, sorry about that. Give me a second.
Yeah, hi, can you hear me?
Yes, I can hear you.
Okay, great. That was quite insightful. A question I was going to ask is, when you're looking at applying the African discounts to it, are you looking basically at a scope or scale of market where the market in question is strictly African, not necessarily emerging markets? Because it's possible to have a technology that appeals to emerging markets in which you have a lot of African countries, but then expands beyond Africa.
Yeah. It's a tough question. So your question is to what does the discount apply? It really does apply to African sourced revenue rather than African created technology or where it's sold. And the simple reason is what I said earlier about FX, about friction. Somebody mentioned also about political risk, etc. All that gets rolled into a little bit higher risk profile that most people on this call can't do anything about, but just need to navigate around. So it's Africa sourced revenue. I mean, I'll give you an example. There's a company called Clickatel, which some of you may know. It's in South Africa. They sell in Nigeria, South Africa. They also sell in the US and elsewhere. So, it's not like a business like Clickatel is itself inherently worth X% less. It's just that people look a little bit differently at its, for example, Nigerian revenue as a result, probably relative to revenue in other geographies, just as a high level answer.
Okay, gotcha.
Thanks.
Thank you.
Great.
Yeah, thank you.
Yvonne, we're going to let Yvonne Johnson ask a question.
Sure.
I'm not supposed to tell you this so that we don't give you opportunities, but one or two people say they'll buy the masterclass.
Oh yes, well it's I guess the price just went up. It was going to be $9.99. Now it's going to be $19.99. But anyway,
I'm actually going to have the TechCabal team interview you once a week, have you on the podcast.
Right. Okay, fine. That's fine. We'll give away the first episode for free, but after that, so we do freemium. But whatever.
Gotcha.
Yeah, someday. So your question is about not cluttering the cap table?
Yeah, just elaborating a bit more on that point.
Could you be more specific?
Yes, Yvonne, I wanted you to clarify.
Yeah.
Okay, we'll get her on in a minute, but let me ask you other questions.
Yeah, so not cluttering the cap table. Well, let me give a couple of answers.
Yeah.
The last financial instrument you take as an investment in the company, assume that's going to be the next one and the one after that and the one after that. Okay, so if you take a very expensive instrument, meaning a very high interest rate, and maybe it's a participating preferred in it, so it's quite technical. So I don't want to get into too much detail for people who don't care. But if it's an expensive instrument, you're going, and you say you raise $5 million in an expensive instrument, just imagine when that instrument is $50 million.
Gotcha.
Now, that's easy to say because I'm not the one raising money, and if that's the only option you have, then okay. But a lot of companies don't take the step of trying to simplify their instruments, even if they give up some equity in order to simplify it before they raise another round. I can tell you unequivocally that simplifying something complicated, even if it costs you as a CEO a little bit of equity to do it, is far more valuable than trying to raise money with a better quality, cheaper instrument later and having the same terms handed to you over and over again.
Gotcha.
So a little bit of pain, it's the little pain today saves a lot later.
Okay, all right, cool.
I don't know if that answers it.
I hope that does I hope that answers your question, Yvonne. Atto Benciencio, can we get live to ask a question? Hi, Atto. Actually, your question.
Sorry?
Hello?
Hi, Atto.
Hello?
Yeah.
Yeah, so my question, sorry?
Yeah, go ahead.
So I was pretty much asking, to what extent do you think, these, big companies in Silicon Valley, big people who are flush with cash in China are going to take over the acquisition space, right? And in a couple of years, we're just going to end up with, majority-owned firms, firms that are majority-owned by outside parties who maybe may not have our best interests at heart, but they're just here to make money.
So you would be surprised how few acquisitions the tech majors do, generally. And you would be surprised that such a large number of them are basically acqui-hires. They will buy a team and some technical capability in some area, and it's very small. I mean, Google does a reasonable number of deals, but a lot of them are tiny. And, we only know about Nest and YouTube and whatever, but, there's very few. And compared to the amount of money they have, I guess the proof is that they have an enormous amount of money sitting on the balance sheet, and they haven't used it to do big deals. So it is very unlikely that they're going to splash money around acquiring. The reason is they don't have to. Gotcha. It's cheaper for them to develop stuff. So I think your question, from that point of view, if you're concerned about it, the concern is their internal R&D capability. I think it was a recent piece I read that the amount of Amazon's annual R&D exceeds some big proportion of the rest of the industry combined, something like that. It's enormous, right? It's innovation, and then being able to roll it out at scale and fund it rather than doing acquisitions. I think acquisitions will happen for the people trying to compete with majors. And if you look at it today, the vast majority of deals that matter are done by companies, most of whom you've never heard of. I mean, gotcha. Network International, for example, I'm talking about DPO, this is not a very famous company, reasonably well known, but not more. And that's the trend. It's not the majors. They're just going to innovate and deploy. Why the hell should they buy?
Let me ask a related question, which is basically, where are you seeing the money coming onto the continent from? The US and the West, Europe, China, and how do you see that changing?
Yeah, it's always risky to do these 50,000 foot answers. So Europe and the East Coast of the US.
Okay.
For the West Coast, it is very hard to get, I'm talking about large rounds, but we can also talk about buyers, I guess. But for the West Coast, Africa's just too far away. They don't need to. China, there's a lot of talk about, China taking over Africa, and in many infrastructure areas, and in certain countries, we can see the effect. But as far as funding growth companies, no, not yet. I mean, sure, we had OPay. I guess you could say they funded a growth company. But how did that turn out? I mean, is that sort of a poster child for, pumping Chinese money into Africa successfully? I'm not sure anybody would say that. So, very little.
I've got a really interesting question here from Emeka Jene, and he said you mentioned about multiple lines of revenue in emerging markets. So he wants some context on, is that about mitigating risk? Is that about how much diversification is too much, and why are you diversifying, basically? Or why do you need more revenue?
Sorry, so your question is the positives and negatives of multiple lines of business?
You kind of said it as a given that you've got multiple lines of revenue. And so he wants you to clarify on that. Is that an expectation? And if so,
No, it's a negative.
Okay,
it's a negative. And the reason it's a negative is that usually the multiple lines of business end up being of much lower value. A company does distribution of other people's products at, 10% margin versus selling access to their own platform at 60% margin, for example. A company does related services to something they're doing, and those services they can't charge very much for. Etc. Those kinds of things, the services, the lines of business that hang off of the core that a company is trying to build. In developed markets, those related lower value services would be valued at a lower multiple. It has been the case in Africa that it hasn't so far, again, because there are so few companies of some scale, but it doesn't make it strategic value. Any buyer looking at it says, that's really pretty low value. I don't really care about you distributing other people's products. And again, I'm making 50,000 foot generalization, but those things are typically lower value. And so if you have a business that you would like to sell for a high price, those lines of business are going to be worth a lot less and may, in some cases, turn off a buyer who otherwise would be interested. We've mentioned DPO 3 or 4 times because it's so recent, but DPO was as pure a play, a payment service provider, as you can potentially get in Africa. They didn't have lots of different lines of service, didn't have anything that was lower value. Therefore, they could get a very attractive strategic multiple from somebody like and actually do a deal because it was a relatively, quote, pure asset. Now, look, I'm trying to solve for purity here because, again, it's messy doing business in Africa. And if you don't want to take the risk of internationalizing too early, well, how do you keep growing? I mean, it's easy for me to say, grow 40% a year. And by the way, I don't do other lines of service. And you'd say, well, that was a helpful conversation. I get that, right? So it's a balancing act. So let me give you an example. I talked about SaaS companies internationally. Many of them have 30% of their revenue services, and it gets valued like a SaaS multiple, okay? When it gets to 35, 40%, it starts to shift, and people start looking at the 2 lines of business. So investors, buyers will tolerate some. It's just that your core should be your core and should be a majority.
Okay, fantastic.
But that's company specific, and it has to be answered in the context of any company answer. Otherwise, beyond this, I'm arm waving. Let's keep going.
I think that's pretty clear. Dotun, how's it going? We're going to have you ask your question live.
My question is really about expansion. So how does that impact Pan-African expansion? How does that impact pricing, both valuation pricing when you're raising a round and also value down the line? Just wanted to provide more color on that.
A company that successfully demonstrates that they can be, quote, Pan-African, and quote, Pan-African is different for different companies, right? So let's not race ahead of ourselves and try and define it ourselves, it depends, is usually worth 2x a national company.
Oh, wow.
Same amount of revenue. But I mean, if a company's doing
a simple, clear answer to that question.
Yeah. So if somebody's doing $10 million of revenue and would be worth, I don't know, $25 million, I'm just picking numbers, as a national company, that same 10 million but say 6 million in one market and 2 in 2 other markets that are growing quickly is probably worth 50, not 25, plus or minus.
Okay.
I mean, again, I'm wrong because I'm giving you a very precise answer, but you get the idea.
Okay. Dotu, answer your question?
Yes, it does. But maybe, I mean, because I'm Oliver Twist, is where would you suggest that it goes to? I've heard you talk about particular countries. So Nigeria might have more weight than if you expand to, let's say, Rwanda, for example. And and there's a triangle that one can play, one East Africa, West Africa, and Southern Africa. But how would you suggest a company that's starting from Nigeria thinking about the expansion to optimize for exit value?
Yeah, so if you're in one of the triangle points, okay, and let's say, so if you have 50% of revenue in your triangle point of origin, okay, or 60%, if it's 70, 75%, it gets to the level of, you know, you don't have enough international expansion. If it's 30%, then something's wrong with the home market, roughly. So I'd say probably if it's 50, 60%, again, I'm overgeneralizing. So, you know, if this is 51% right, we're doing pretty well, okay? So please, just take these as guides. And then the rest split between 1 or 2 other reasonable sized geographies, either the rest of West Africa, if that's possible, or Kenya as an option. Very rarely do we see companies that are in Nigeria, East Africa, and South Africa, a third. I don't know one that is. So, you know, you're really trying to play for enough demonstration of being sufficiently Pan-African that once somebody makes a significant investment or does an acquisition, the next 5 years will prove that Pan-African platform fully. You just have to look like you're on the on-ramp to do it. Now, in 5 years' time, 10 years' time, the demand for what does Pan-African actually look like will have gone up because companies will have scaled to a certain point. But at the moment, they're not developed enough or big enough generally that you have to have that higher level or higher spread than otherwise. So a concentration in one home market and a distribution in other markets is probably good enough for now, but it's very sector specific, as I said.
My question was, in Africa, as you said, many companies have to build infrastructure, which does not just include physical infrastructure, but also manpower, right? So in many spaces, people talk about physical sales agents, right? So for a company which has both warehouses, logistics in terms of driver partners and physical agents, how would you then say they would present this as an appealing factor to investors?
So I think we talked a bit about this right at the beginning, which is basically you spent all this money on ground infrastructure to build your business. We actually talked quite a bit about that.
Yeah, there are ways of presenting it. So for example, if you have built up a physical infrastructure that as a tech-enabled business doesn't add to value. It's just sort of something you needed to do. But by the way, when I say physical infrastructure, it's not like you own all the warehouses necessarily. You own all the trucks. Just, you know, you may lease them, but you have those as assets. There's some simple things that are optics. You know, it's possible, for example, to put all of that into a separate subsidiary of the company and just say, well, it's our, I don't know, operational subsidiary, for example. And, you know, that's not actually the main business. All it does is move stuff around. It doesn't change anything, but optically it looks like we've got a clean tech-enabled business that happens to rely on this subsidiary until it doesn't need to anymore, for example.
Wow.
Yeah? That's just a simple way of doing it, and immediately like that changes perception.
That is fascinating.
Right? So now, well, we don't need to do the master class now. We'll keep going like this. And by the time we've done it, you know, we'd already done the first episode. So I don't know. But okay, fine. Well, this is, you know, whatever. Lucky for you, I have no ambition to do it. That's one, right? There are other ways of doing it. For example, if one looked at, say, we raised $10 million so far. And of that $10 million, we spent X in doing something. Therefore, really, when we look at the capital efficiency, with capital efficiency is how much money did I use to generate X of revenue, it's very valid to take that first few $1 million out of the equation, say that was basically setup money that you wouldn't spend, and capital efficiency, meaning the revenue relative to the money invested, can be looked at excluding that. And the reason that can be credibly looked at is because that's the way a company would be looked at in Europe. They wouldn't have to spend this money. So if people are benchmarking the opportunity relative to international opportunities, well, you have to benchmark everything relative internationally. So there are adjustments that can legitimately be made. You have to be wary about, excluding this and including that, and all of a sudden you can't really tell what the numbers are. But within reason, there are ways of doing it. There's just 2 examples. Again, there's another 40,
But they should pay you for that additional 40 when they're ready to do their deal.
well, that's why people do.
Excellent. So keep in mind, Magister Advisors, people, in case you're looking to do your next big deal. Victor is the person to talk to.
Obviously, and it's Basta at magisteradvisors.com. Shameless plug, but anyway, that's the point.
Victor, I want them to come through me for the introduction.
We can play whatever game you want.
Thank you so much for joining us. This has been really, really useful.
Thank you all. I'm glad it's useful. Sorry for the little interruption.
Yeah, there's a lot of really interesting questions still left over. Please follow. We're going to do a recap of this conversation. We're going to do some more interviews with Victor because he has a lot more that we can talk to him about. Again, if you heard anything else interesting, plug it online, #TCLive. And join us again. We do this every Friday. Lots of interesting people. So please come back for another edition of TC Live. We're actually talking about exits for quite a while and acquisition conversions. So the next few sessions of this, we'll be talking to other people, some of whom have actually done some of these deals. So please follow along with us.
Okay.
Thank you so much.
Very good.
Have a wonderful day.
Thank you for having me.